All right, for the second day in the past 3 sessions, we've had a pretty quiet day, and notably the 2 days I've done these market outlook videos, the market pretty much hasn't done anything. Very small ranges, very small volumes. On Monday, we were kind of heading up against, at a resistance level, the top of this kind of resistance zone that we're in. Today, we're kind of back down at the bottom of this resistance zone. So we're in this noisy period without really a clear direction either to the upside or to the downside. Now that could change once we get some inflation data out by the end of this week, heading into the July 4th holiday in either direction. But as of right now, you can kind of see it's a pretty sideways move. I do talk about today though some indicators and what they're showing us in terms of, what kind of market we're in. Are we headed towards a bear market? And if so, has it started? When will it start? Right? I mean, you hear that thrown around so much. Are we gonna? Are there things that can show us we actually get new highs by the end of the year? And there are. So we're not. If that's still the case, then that means we're not in the bear market, because bear markets don't reach new highs for multiple years. So we're gonna break all that down today. We're gonna talk about what's driving. There's a big move today in another asset class besides stocks, even though stocks were flat. So we're gonna break that down, what that tells us, and what kind of direction move we might get in that asset. And then our trade idea as a SOC is very similar to another one that we've done here recently. We're going to take advantage of a recent upturn in what may be a new leg lower to the downside, and we'll talk about how to trade that. So let's go ahead and get started. Today is Wednesday, June the 29th, 2022. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, before we get going too far, I invite you to subscribe to our YouTube channel. Hit that subscribe button down below. Like us, click on that thumbs up and like the video. Comment down there. Join our website at MarketScholars.com. There's a link popping out up there in the top right corner of your screen. Follow me on Twitter for more content between the videos from day to day. There's my handle at DavidSettle42, and join our Market Outlook Facebook group that we've created. Also, if you're watching us on our blog at MarketScholars.com, there's a lot of things on this page. Come down to the bottom, hit that heart. It opens up a new tab. Hit that like button there. Also, click on this thumbs up icon. It opens up another new tab. Hit that like button. That helps us get our content out. When you do that, it helps us get our content out to more of our followers. So we really appreciate those who do. All right, let's start off taking a look at the S&P 500 with the market forecast indicator. You can see the intermediate line here getting into really darn close to the top of bearish territory. Closed at 39th percentile. So the bearish territory is in the 40th percentile. We are still more than 2.5% below the 30-day moving average, so it's still in bearish range too for the S&P. And you can see, you got this kind of range of moving averages. Just to remind you what these are, the black line is the post-2009 low point rally. The red line is the post-COVID low point rally. So both of those are off of really long-term bullish moves, retracements of really long-term bullish moves. And then the green and the brown lines are retracements off of bearish moves. So the brown line being from the year-to-date high point, and the green line on the current intermediate decline that we're on right now. That we still haven't finished yet. I mean, it came close to finishing there. Didn't quite get into bullish territory. It was barely in the 50th in the upper half of the chart. So not quite finishing up there. And you can see short-term sentiment got pretty bearish. Near-term line well into the reversal zone. Now the question is going to be, so this peak is a lower peak. So are we going to go down to a lower near-term low point? Right, that's the question, right? So we'll see how long this little dip lasts. If we can get strongly below like 3,800, then there's a pretty decent chance. I mean, just to kind of give you an idea of what that looks like here on the intraday chart for the SPX. You can kind of see this gap here, that we jumped up on Friday. That's about at 3,800. It's about where the low point was today. We got to 37.9975. So that was about as low as we got there. So if we get below, today's low point, and you can see we closed just a smidgen below yesterday's low. So lower high, lower low, and just barely closing below yesterday's low. So if we end up with another lower high and a lower low and get below 3,800, then you see there's a pretty decent chance here that we break down back down below this kind of range of Fibonacci resistance and start, a new leg lower to the downside, which I believe would be probably the last leg lower on the current. I mean, to have two big long intermediate declines on one market sentiment drop, that's a pretty long drop. I mean, we've been going at it for 6 months. That's a pretty average, maybe higher end average, but it's a pretty average length of time for a correction. The average length of time for a correction bounce would be about 2 to 3 months. So we're in the late stages of this correction. The question then will be, will we get a bear market out of it, right? Because after a 2 or 3 month correction bounce, then your bear market's in the last, the short ones 5 or 6 months, and the long ones 18 or excuse me, more like 16, 15, 16 months. And they can last quite a bit of time. As I tweeted out here, I tweeted out for those following me on Twitter, this chart that got picked up by the chart report. I was pretty excited about that because it's a really good post every day that kind of gathers some really good technical analysis charts. So they picked up on this post. Here's all the bear markets that we've had, and you can see every bear market has started with a 2-quarter streak of 3% or more declines, almost 5% or more. There's been a few other smaller ones. You can see that one right there. There was barely more than 3%. And then you had another one over here where you were barely more than 3%. So, I mean, we weren't barely more than 3%. We're almost 5%. And then well down to 15%. Well more than 10 on the second one. And that's typically what you get. You get some pretty big streaks to the downside when you start these bear markets. Like we saw in 70s and the early 80s, and then the 2 back-to-back bear markets that we had in that 2000 period after having such a big, long bullish streak. But you can see how, like, for example, that one lasted after the correction bounce in May. We had another 3 quarters of declines. Over here you can see the correction bounce there in April of 2001. Then we had 1, 2, 3, 4, 5, 6, 7 more quarters of declines, and so you can see it, like, after you get the correction bounce, these are quarterly periods. So we're going to get the bear market. That's when the bear market starts. And so I think we are in the late stages of a correction. I think we're on one last leg lower where the near-term line kind of stays in this, and we end up getting down to these lows, if not maybe a little bit lower by the time all is said and done. Especially now that the energy market, the energy sector, is really starting to participate. You can see the NASDAQ 100, what it looks like, very similar, back down. It is not quite like it did get. Let's see if I were to draw these. Let me activate some of these lines here and get it down to their new lows. So, and then this one here, we'll activate that one and get it down to its new lows. So you can see we did get up to the 23% retracement of the intermediate run and held that for resistance. The 23 of the long-term year-to-date rally is still there. The 23 and the 38, see these two lines right there. For the S&P 500, remember, we are just barely potentially getting back below them. So why do I think we'll continue to get below them? Because the NASDAQ already has. The NASDAQ 100 is well below those two lines. Like, we broke below those back in May, and we retested them in early June, and now we're working our way back down. So we're already below those on the NASDAQ, and you also notice too, there's those two lines right there. We're well below them too. Again, we dropped below them in May, we retested them in June, and we're back down below them and starting to work our way. Remember, the NASDAQ held the green line for resistance, the current intermediate 23%. Same thing with the Russell, and you can see the long-term decline that actually goes back to November for the Russell. Remember, the S&P and the NASDAQ got new highs right here in January, but the bear market decline, the market sentiment decline for the Russell started a lot earlier. Started kind of post Thanksgiving, and so that the 38% retracement of this intermediate decline lines up with that 23% line, and we never even get close to testing that resistance level. And then you can see the 38% is lining up with that red line, and the green line here, the 62, So you can see where they're the significant, when you have multiple lines, and these are all very significant time frames, right? The black line, again, post 2009 low, the red line post COVID low. Those are very significant lows that a lot of people are going to anchor to. And then these two are these highs, this high, the pretty much all-time high for these indexes for the orange lines, and then the March high, that all these indexes, pretty much they all got clusters there. So the March high for the current intermediate decline, those are all, again, very common points that we're anchoring to. And so these are going to be some very common support and resistance levels for these major indexes. Right, and you can see the intermediate line dropping, or the near-term line dropping back into bearish territory. Let's take a look at their weekly charts. And you can see here on the S&P 500, again, you still got the red arrow, you still have falling PPO, and you don't have the negative differential, but it is a neutral candle, and we're hardly bullish at all on that. The NASDAQ 100 looks very similar. We've had a couple neutral transition candles in a row. And then your Russell 2000, again, with falling PPO, so they haven't started to rise yet. And we actually still do have a negative differential despite the transition candle. So it's one thing to get a transition candle like these, because they can really point to the upside, like some of these did. But it's one thing to get those transition candles. They typically occur like that, right? So you can see this Hakanyashi here, like that transition led to a temporary bullish move. But when you get a transition like this, this is typically what it looks like, right? The real candle is really bullish. So that's kind of what it looks like. Well, if you look at the current transition candle that we're getting on these indexes, there's the Russell, and again you go to the S&P, and we're getting a transition candle on that one too. Well, if you look at the regular candle, they're not that bullish. In fact, still pretty bearish. So not the transition that you would expect would lead us to the upside. Like say, again, going back to March, that 14th, the week of March 14th, that's what would be a bullish reversal when it looks like that. And that's hardly what we're getting right now. And so it's hardly a, reversal type pattern as you would expect it would normally. Looking at the 3 green arrow charts, you can see them, we don't have any 3 green arrows right now, but we don't have any 3 red arrows either, so we don't have any pink or green shading. The MACD histogram is rolling over, and the stochastics is at a point where any rollover, you're just you're at the top of bearish territory on all these stochastics. So, you roll back over on that, you're already pretty much back in the bearish territory. And the MACD, like I said, is rolling over already too, headed towards a potential red arrow, where all of the stocks are all trading below their moving averages. Let's take a look at the 2-line version for SPY. You can see, again, where all those lines are and kind of how we're flirting with that range. That we are flirting with the top end of that range at the high point, and now we're flirting with the bottom end of the range and for the new leg lower. But we are back below the 17-day moving average. The MACD is still above its moving average, so we're back to convergence mode. So that means we're not going to really dive to the downside. If we're going to move lower, it's going to be more of a grind until that MACD gets below its moving average. But as long as it's still above its moving average and the histogram rolls over, we're probably just going to kind of grind our way to these lows. And like I said, if not, eventually to slightly lower lows. You can see on the weekly chart, the target was at 200-week moving average. That's only from the lows that we got there at 362.17. That's only about another 10-11 points away. And that's the range right now is about 9.5 points. So that's like another day or two. Once you get to those lows, it'd be like another day or two of an average range right now. So you can see how easy, and especially whenever there's no volume in this area to hold you up, to stop you from getting down to that moving average. Let's take a look at some of the other oscillators. The DMI was kind of flirting with like reversing. It didn't, right? So we're still below 25. We're not back below 20, but we are back above 30 on the negative indicator. When you look at the RSI and the CCI, again, they're trying to get in the upper halves of the chart. The CCI did barely, but they're working their way back down. Looking at the Ichimoku cloud, We still have a weak bearish trend, so it didn't drop to zero. The other thing too, you look for a reversal. There's a couple of things you look for here. You look for the red line to drop below 70, you look for the green line to drop to 0, and then a spike on the green line to 100. If we get a spike on the red line to 100 first, which would mean a new low, then it kind of throws that out, right? So, tomorrow the green line will hit 0 because we're not going to get a new high. So the green line will hit 0. You'll have 2 of the 3 things for a bullish reversal. The third thing will be the green line spiking to 100. But if we start flirting with these lows, you'll actually be more prone to the red line spiking back to 100 like this one did here. So that's something to keep an eye on there. And then the other thing too, the stochastics here, I think we will be more bullish if we were to break into the upper half, especially above 60 into the bullish territory. And you can see we're not, so we are still down in here. So if we were to break through these levels, then and get back above the 30-day moving average, then there's a good chance that we might be starting the correction bounce. But I don't think we are yet. I think we are going to hold this resistance and stay in the lower half here until we finish forming these, wherever we end up, 3,500 down into this area right here. And you can see, you can see if I were to, where did that go? Look at the Bollinger Bands for the S&P by July expiration. One standard deviation is at 357, so we can get 350 coming by the end of July. One standard deviation, I don't think we're going to have big moves, so I think one standard deviation, getting to 350 by the end of the month probably is a pretty reasonable expectation, and then starting your correction bounce after that. One last thing to look at here. We're looking at the Bollinger Band. The bandwidth is shrinking, so that means it doesn't mean that we can't go down. It just means we won't go down very fast. But because the bandwidth is still wide, it means we can make pretty decent sized moves still without quote unquote breaking out. The other thing to look at is the Keltner channels along with this, and you can see that we still have negative momentum down there that's actually declining. But you are you're not getting into, you see how on all these other bullish moves, you barely got in the upper quartile there, but you never broke above 100 to really break out. And then here you never did get to the upper quartile, and here you're not even getting the upper half yet. So you can kind of see what you need to see. If we're going to really kind of turn this negative momentum around, you can see what kind of bullish move it would take. And getting above the 23% lines would probably do that. It would probably get us into closer to the upper quartile of that bandwidth. Let's take a quick look at the volatility. The volatility still is really, really light, very small range. The volatility of the volatility is still down to really, really low levels here. Again, it's not low levels compared to where it's been in the past, right? It is actually kind of average for where it's been in the past. It is low levels for the type of market environment we're in right now, and a lot of that is you're just not getting the same amount of call buying that we saw. But the VIX still is for how. And again, there's a few things I look at. One is where historical volatility is, well above 30. The other is where the average ATR is, the relative ATR, which is about 2.5%. And then the other is the VIX 3M, and for that matter, the VIX 6M, right? Those longer term volatility indexes are all really high, above 30 for the VIX 3M. So generally speaking, when they are this high, the VIX tends to be a lot higher than it is right now. When the VIX, you can see in 2018 correction, when the VIX really spiked relative to the VIX 3M, the VIX 6M only got to 26, and now we're at 30. So these long-term volatility, what this tells us is that the market is not, this is not the typical buy the dip, the options market. Based off of what the option market is telling you, that this is not the typical buy the dip correction like we've seen for the past however many. That more than likely that there's a lot more demand for these longer term put options than there is for the short term, which is again is very typical for a bullish environment when the long term VIX volatility index are low, when they're below 20. It's not typical when the VIX 6M is up to 30, for the VIX to be less than that. Because usually, like again, the last time we got up to this, where did we get up to here? Right now we're at 30 right now, but we were at 34 when we peaked here at June expiration on volatility. Well, the last time we got up to 34 was right there on March 9th. The VIX was right around on March 9th of 2000. The VIX right here, the VIX was at 54. So, we did not get to 54 here in the middle of June. We got to 32, 33 when the VIX 6M and 3M got to 34. So when you look at three things, the relative ATR, the historical volatility, and these long-term volatility indexes, when they are as high as they are right now, the VIX tends to be a lot higher than just 28, and a lot higher relative to these long-term indexes than below 100%. So that's why I say the VIX is really, really low right now, because of that, right? And that's you can see the put-call ratio is moving higher, and I tweeted that out too, but it's based off of lack of call buying, a severe drop-off in call buying, but not as big spike in put buying, and as referenced here by what we're seeing here. And so I think, again, this is not your typical buy the dip correction that will lead us to new highs, despite what the seasonality charts are telling us right now. That would lead us to new highs by the end of the year. Seasonality tells us they're screaming. There's multiple cycles screaming to us that we should be at new highs by the end of the year. The likelihood is very minimal, right? I think this is going to be eventually turn into a bear. By the end of the year, we'll probably be starting the bear market after having finished the correction, 2 to 3 month correction bounce, back down to that 200-week moving average, wherever it is by the time we get there. And then the bear market starts when we break it. If we break it this time, it'd have to be break it that second time. That's when the bear market starts. And that's from that point, we're talking 3 to 4 more quarters of declines, as based on what we've seen in the past. So what do you think? Do you agree with that? Do you disagree? Let me know in the comment section below, especially if you disagree. Tell me what charts or indicators you're looking at that tell you why you think that we will probably get to new highs by the end of the year, or why you might be a lot more bearish than I even am right now. Maybe you think the bear market's already started. So what indicators are telling you that you're a lot more bearish than what we've seen here? Post those in the comment section below. All right, now let's take a look at what's driving the price action. You can see over the last 3 months, it's interesting to see the commodities and the dollar doing as well as they've done together over the last 3 months. On the other end of the spectrum, U.S. equities really getting hammered pretty big. 16.5% for the S&P, 17% for the Russell, 22% for the Qs. If we were to zoom in on just today alone, we'll go into just today. You can see small caps are down a full percentage point. The Qs were up a little bit. So kind of a departure from what we had seen previously. Just going so far this week, you can see the Qs were down quite a bit this week, and the Russell was the one that was really holding up tremendously. But today that flipped. So the Russell went down, still is not down as much week to date as the Qs are, but caught up a little bit and actually kind of came below the S&P 500. On the other end of the spectrum, bonds rallied today, so that's a big move to the upside for bonds. Bonds have been weak. See, they started off the week really weak. Then they had a really strong day here today. Ended up 1.5%. Let's take a look at what that looks like here. So TLT, which is not the 10-year yield, it's the 20 to 30 year. You see, for the second time in a week, it's broken above its 17-day moving average, with the MACD already above its moving average. So we're looking at the possibility, the opportunity for this to get going. It's got to break the 30 and the 50, but if it does, then you see the gap to fill up to the 200-day moving average. From a weekly standpoint, the MACD is now easily above its moving average, and then of course you would be looking for a break above the 17-week to get a divergence, bullish divergence going, a good strong bullish move to the upside. But at least, the very least, it does look like we are consolidating, right? We are trying to figure out a low point in this area, that the worst for bonds, at least right now, is over. Whether we get a new leg lower to the downside or not remains to be seen. I mean, this is, since TLT has been going, this is the lowest that it's been relative to some of these moving averages. For an example, the 17 period moving average, if I were to go all the way out, that's the lowest it has ever been, right? The other second lowest was there, and coming off of that bear market low point in 2009, and then you can see another really low period there in 2016, coming off of the election news, and then of course here in 21 when we had the reopening trade. Those were all some real significantly strong momentum to the downside. If I were to change this now to, like, say, the 50-week moving average, simple moving average, then you can see we've never been lower, right? So we are extremely low, and you can see now the MACD is finally turning up. That's a significant move to get the MACD turning up over with these red dots, meaning that we're in the 10th percentile or less. Again, like I said, I think that tells us that the worst for bonds is over with. Like, we have come down, and we are in the process of forming a low. And that process may take weeks, but we are in the process of forming a low point, especially considering we may be in the last leg of this current correction. We might get a pretty decent bullish move on bonds during however long this bout of risk appetite lasts. The other thing to watch closely is the dollar, and especially let's look at the dollar versus the yen. So the dollar versus the yen, you can see this has been one of the most bullish times for the dollar versus the yen. The other bullish time was going into 2013 when we were starting our bout with a QE, right? So this is much more bullish period right now, and you can see how it's just gone parabolic to the point where the DMI for the dollar relative to the yen, dollar relative to the yen, the DMI here on the weekly chart has just gone parabolic. I mean that is a tremendous. Getting up above 60 is, that's high. We haven't gotten above 60. We've got above 60 over here on a bearish move. I got up to 68 in a couple of these. This is back in the 80s. But since the 90s and since 2000, when we kind of started the new world order with the euro, we have not even come close to 60. This would be the closest that we got to in 2013 again, when we were up to about, what, 55, 56. So very, very strong ADX. Again, essentially just telling us how parabolic we have gotten. We are in, from a market forecast standpoint, we just barely had that cluster there. On the daily chart, if you look at the weekly chart, we just got a cluster a few weeks ago. We're actually up to a higher high from that cluster, but we're well above the 30-week moving average, farther above the 30-week moving average than probably we've been in the last 20 years. There's been a few other points where we were this far above the 30-week moving average, and you can see what happened, right? The dollar dropped pretty sharply there. The dollar kind of went sideways for a good chunk of months before getting the last hurrah, and then a really significant drop there in 16, 15, and 16. And then again over here, the 2013 rally, and then we went sideways, up and down with some volatility. It's a big sharp drop there, but then up and down for about a year there. So needless to say, we're pretty parabolic and pretty bullish here on the euro versus the dollar versus the yen. Here's the dollar versus the euro. Again, we've gotten these bullish clusters, multiple in a row. The intermediate line is still pretty bearish. The daily chart is still down here, but it looks, in my opinion, too, that we're trying to form a low point here on the euro relative to the dollar. So dollar's trying to find the high point, and if the dollar were to start to roll over, remember how bullish commodities have been. See how bullish the dollar has been in the past year. Commodities have been really bullish too. So imagine how bullish commodities would have been if the dollar were weak, which is typical right? Because commodities are priced in dollars. Usually a weak dollar is what pushes commodities higher. If commodities have been this high with a strong dollar, then commodities are about to get really high with a weakening dollar. And if again, these really high commodity prices are one of the big drivers for risk aversion. So again, if we're kind of talking about what could be the catalyst that kind of steers us towards longer term bear markets and recessions, these sky high commodity prices, but now with a falling dollar from really high levels, definitely it would be a catalyst for that to happen. We looked at the 10-year long-term bond. Here's the 10-year yield getting back below its 17-day moving average again for the second time in 5 months, with the MACD already below its moving average. So we're in bearish divergence mode again with the 30 and 50 so close, without the gap in between like we even had there. It makes it very likely that we can close below both. Right, basically getting below 3% would be an important low point support level for the TNX, and would put some of these levels back all the way back down to 2% essentially in play, because there's just nothing in there that can hold you from a support standpoint. You can see basically from a Fibonacci standpoint, the bullish move started here and then would be ending here at that 3.48% mark. So again, getting back below 3% would be starting the decline, starting the correction, and then you can see where your support levels would be. Let me move this out, get rid of some of these drawings, so get rid of this one too for that matter. You'd be looking at a 2.67% would be your next layer of support. Again, probably would happen in a situation with a risk aversion with long bullish bonds, but that I expect that would be temporary, as I would think that yields would start to rally again with commodities if inflation continues to be a persistent issue. Alright, so for our trade idea of the day, I wanted to take a look here at Occidental. We've done a previous market outlook trade on Valero. Looks very similar now to Occidental. So Valero also has had a bullish rally. I wanted to take advantage, but I don't want to do another trade on Valero, so I'll just do another trade in the sector. Nice, good bullish engulfing pattern filling in the gap. The intermediate line did jump up above 20, but still easily in bearish territory with the near-term line falling, and the near-term line not getting into the upper reversal zone would be really bearish if the near-term line extends more to the downside tomorrow. You can see market sentiment lines falling, so it appears that we're in more of a decline from a long-term standpoint here on this weekly chart. You can see that we've had some bearish candles. We're getting a little bit of a transition candle, but remember, if it's not a transition associated with a good bullish move, then it's not the best transition. It's more likely just going to be a continuation of the bearish move, especially with falling PPO and the differential still there. If you take a look at the whole really quick for Occidental, you can see it's been a nice little bullish move. It flipped the parabolic SARS, but just like that, you have a transition candle on the daily chart. The MACD is already rolling over. The 200-day haul has rolled over to the downside, and we're not that far away. Like usually we kind of move up and you've got a pretty decent distance. We're not that far away from those lower parabolic SARs, so we can flip that right back up to the upside, especially if we end up with the tomorrow's Hakunashi Open will be right there about 60.30. We're already at 59.10, so we're already in the mode, and we're trading a little bit lower in the after hours. We're already in the mode for a bearish candle already to be setting up on there, depending upon how we finish tomorrow. From a 3 green arrow standpoint, pull up Occidental up here, you can see we just barely got, we had dark pink shading for a while because we had 3 red arrows. We did not get green shading, and now it looks like we won't, as we're not anywhere near the 30-day moving average. In fact, we closed back down below the 8-day, or came really close. And look at that. If we get below this support at 58-ish, 55, 56 in that area, there's nothing from a volume standpoint stopping it from getting towards that 200-day moving average. So looking at some of these other oscillators, again, we were trying to stop being bearish. That didn't happen. We kind of hit support on the negative indicator, hit resistance on the positive indicator there. If you take a look at the trend strength indicators, we did stop with the bearish trend, so we don't have a good strong trend going, but we also did not get above the cloud. We're actually back down below the cloud, and the red line's nowhere near getting above the price, so it's going to easily be below the price. So we're still very much in bearish territory there. And then when you look at like the Bollinger Band width, we basically just hit the midpoint as a resistance, like it does, and have with the potential of rolling back down to the downside, with the RSI and the CCI also appearing to be hitting their own resistance levels. So what we decided to do on this was come over here and do a pretty aggressive long put vertical spread for August expiration, buying the 47.5, selling the 45. A very, very small risk, so less than normal for a directional trade, so less than $500, by getting the $2,000 reward. So you're about 4.5, maybe not quite 5 to 1, but more than 4 to 1 reward to risk ratio here. It's probably about 4 1/3, 4.5 to 1. So really, really good reward opportunity to very small risk, but it has to move. So if it doesn't move, then you can see how we'll just take a small loss on this and get going, and we still have the trade on Valero that can still work itself out, right, for July expiration. We're already in maximum gain territory. It just needs to now stay down here for us to get where we want to get. All right, well, that does it for today. You've heard from me now. Now I want to hear from you. Use that link that's popping out in the top right corner of your screen. That takes you to our Market Outlook forum. Open up any new thread there with any questions or comments you have, or apply to anybody else's thread. And let's keep this conversation going in between videos. Again, thank you very much for watching. Remember to subscribe to our YouTube channel, hit that thumbs up icon, comment on the video, subscribe to our website at marketscholars.com for free. Follow me on Twitter for more content and Facebook for more content in between videos. Have a great rest of your Wednesday night, everybody, and we'll see you all next time.